Welcome to The Explainer. Today, we're going to pull back the curtain on the invisible rules that actually make the whole world of business, well, work. These aren't just ideas. They're the shared language that allows everyone, everywhere, to trust the numbers.
So let's start with a little thought experiment. Just imagine, for a second, a financial Wild West. No rules. Every single business just makes up its own way of talking about money. It'd be total chaos, right? I mean, how could you possibly trust what a company says it's worth? Okay, so to stop that kind of chaos from ever happening, the accounting world came up with a universal language, a set of rules that everyone agrees to play by. So what's this language all about? Let's dive in.
And that language, it's called Generally Accepted Accounting Principles. You'll hear it called GAAP all the time. The best way to think about it is like the official grammar for business. It's what makes sure that a company's financial report in Mumbai makes perfect sense to an investor in New York. Why? Because they're all playing by the exact same rule book.
And, just like any language, GAAP has its own core vocabulary. There are actually 12 key concepts that are the foundation of everything. And today, we're going to get a handle on the first 4. These are the absolute bedrock principles. Get these, and you're well on your way.
All right, so our first concept. It answers a question that sounds simple, but is actually kind of tricky. Where do you, the owner, stop, and where does your business start?
And here's the big idea. For accounting, the business is a totally separate person from its owner. I mean, completely distinct. So even if you're a one-person shop, your company's financial life is not your personal financial life. They are two different things.
So think about it this way. In your personal life, that money in your bank account, it's yours. You can buy groceries, go to a movie, whatever. But in the business world, the cash in the company's bank account, that belongs to the company, period. It's not your personal piggy bank. Every single cent has to be accounted for as a business transaction.
Okay, now this is where it gets really interesting. This whole separation thing has a pretty wild consequence. When an owner puts their own money into the business now owes that money back to the owner. It becomes a liability on the books. It's kind of crazy, right? The owner is basically acting as a lender to their very own company.
So let's really chew on that for a second. An owner puts in, say, another 100,000 rupees. What is that? Is it income for the business? Nope. It actually increases the business's capital, which you can think of as the owner's financial stake. And that capital, it's treated as a liability. It's the owner's claim on what the business has.
All right, moving on to our next big idea. This one is all about keeping things objective and specific. It's called the money measurement concept. The rule here is really simple, but it's incredibly powerful. If you can't put a specific price tag on something, a real, objective monetary value, it does not go in the official accounting records. That's it. The language of business at its core is numbers.
And this shows that dividing line perfectly. On the one side, you've got things you absolutely record, right? Buying goods, paying a salary, the cost of a new machine. But look at the other side. You've got things that are massively valuable, but you just can't record them. Things like employee loyalty, the owner's health, or the company's amazing reputation in the market.
So why not? I mean, high morale is a huge asset, right? Well, it's because you can't express it in dollars and cents, or rupees, or any currency. There's just no objective price tag for motivation. So even though it's a huge deal for the business's success, it stays off the books to make sure everything stays consistent and comparable from one company to the next. Okay, so our next two concepts are kind of like a tag team. They work together to solve a really big fundamental problem. How in the world do you measure how well something is doing if that something is supposed to last forever?
So first things first, we just assume that a business is in it for the long haul. It's a marathon, not a sprint. This is called the going concern concept, and it just means that we operate as if the business is going to keep on going indefinitely. We're not planning on shutting it down or selling it off next week. Okay, but wait, if it's going to run forever, how do you know if you're actually doing well? How do you keep score? Well, that's where its partner, the accounting period concept, steps in. We take that super long, indefinite life and we chop it up into regular, consistent chunks, like a year or a quarter. It's basically like creating innings in a baseball game so we can have a scorecard.
And these regular scorecards, or financial statements as they're called, are everything. They let everyone, from managers to investors, see what's going on. They let you compare this year to last year and answer that one crucial question. How did we actually do during this period?
All right, so let's pull the camera back a bit. We've just gone over 4 pretty fundamental grammar rules of business. But why does any of this really matter, especially if you're not an accountant?
Well, it all comes down to trust. These 4 concepts are the foundation of that trust. You've got the business entity concept, which creates that all-important clean line between personal and business. Then money measurement, making sure everything is objective and comparable. Going concern lets everyone plan for the long term. And finally, the accounting period, which gives us that regular pulse check on performance. You put them all together, and that's what gives a bank the confidence to lend you money, or an investor the confidence to buy your stock. Without these rules, it's all just a shot in the dark.
So, at the end of the day, you see, these rules aren't really just for accountants. They are the invisible architecture that our entire modern economy is built on. It's the shared language of trust that lets us all do business together. So the next time you look at a company's financial report, you'll know the powerful, simple rules it's speaking. Thanks for